So in our last class, we completed the weighted average cost of capital. And you will recall that when we started this class, I mentioned to you that, especially this topic, I told you then that there are three categories of a cost of capital. One is the traditional weighted average cost of capital. Two is project-specific cost of capital. And then three is the weighted average cost of capital. So far, we have completed traditional work. We completed traditional work last week, which we started from day one. It took us about 3 classes. Okay, so today is going to be the 4th class on the cost of capital. Hopefully, we'll be able to complete project-specific and then WAPOCA. Once we're able to do that, that means we are fine with cost of capital. Then in our next class, we'll move to a brand new topic, which is capital budgeting. All right. So you recall again that I mentioned to you when we started traditional work that traditional work is computed when information on capital structure are given. When you are given information on ordinary share capital, preference share capital, and debt capital, including their returns. Okay, once you are given those kind of information, then it means, and you are asked to calculate cost of capital, it means you are supposed to calculate traditional work. Now, today we are going to be doing project-specific work. What are the things you should look out for when you are given a scenario, when examiner paints a scenario for you and you are asked to calculate cost of capital? How would you know it is project-specific cost of capital? So let me explain that to you. Okay. Let me say, instead of writing it in order to save our time, let me see if I have the procedures and the notes in this material. Other than that, okay, I think I have it. I should have it. Yes, I have it. Okay, so let me explain what project-specific cost of capital is all about. The project-specific cost of capital is computed when a company is diversifying or debt equity proportion is expected to change as a result of undertaking a project. So when a company is diversifying into a new industry and there is need to execute a project in the new industry, the existing work will not be suitable for the company to execute the project. Therefore, there will be need to estimate a cost of capital that will be consistent with the risk associated with the project. This is what is known as project-specific cost of capital. Say, for example, equity professional is into education business. Okay, that means equity professional operates in education industry. If equity pro is diversifying into oil and gas, and there is need for equity to undertake a project in oil and gas, the existing work that equity pro uses in education business cannot be used to estimate or to evaluate a project in the oil and gas, because the risk in oil and gas is different from the risk in education business. And that is why when a company is diversifying, there will be need for the company to estimate a cost of capital that will be suitable to evaluate a project in the new industry. This cost of capital is what is known as project-specific cost of capital. I believe that is clear. Now, on the day of your exam, once you can see indication in the question that the company is diversifying, you need nobody to tell you that you are going to calculate project-specific cost of capital. Okay? You are going to see it in the first paragraph of the question. In all cases, you will see it in the first paragraph of the question where examiner will tell you company XYZ PLC, a manufacturing entity, is contemplating in going into the production of whatever. And once there's an indication that the company is diversifying, then of course, and the examiner has to calculate appropriate cost of capital. You should know that it is project specific. Okay, it is project specific. So that is the indication to know that you're supposed to calculate project specific cost of capital. All right, I believe that is noted. Now, there are some terminologies you need to take into consideration as far as project specific cost of capital is concerned. You need to know what is business risk, what is financial risk, what is beta, what are the types of beta, what is proxy what do you mean by proxy company? So let's discuss them one by one. When you talk about, because these are the things we are going to be talking about as we want to go into calculating project specific cost of capital. Therefore, what is business risk? The business risk is the risk associated with the industry where a company operates. Okay, it is the risk associated with the industry where a company operates. So when you want to measure the risk associated with the industry, you use business risk to do that. And business risk is determined using asset beta. So I will explain to you what asset beta is all about when we get there. 2, what is financial risk? Financial risk is the risk arising from debt financing. When a company finances its operation with debt capital, the company may be exposed to financial risk. Okay? Say, for example, a company that wants to borrow money to finance a project. Once a company borrows, okay, the company will be exposed to financial risk. All right? So that is for that. Then number 3, what is beta? Okay, what is beta? Beta is a measurement of risk. Beta is a measurement of risk. We use beta to measure risk. Okay, there are 2 types of beta. We have equity beta, we have asset beta, then 2, we have equity beta. What is asset beta? Asset beta measures only business risk. Okay, asset beta measures only business risk, and it is also known as ungeared beta. Okay, the beta that does not include debts, that is not geared. All right, a beta that does not include debts is what is known as asset beta, is ungeared beta. Okay, that is for that. Then, of course, I will show you how to calculate asset beta as we proceed. But for now, let's continue with our discussion. Then the second type of beta is what is known as equity beta. Equity beta measures both business and financial risk, and it is always higher than asset beta, okay, because it involves the element of both business and financial risk. Where a company is wholly financed with equity, equity beta and asset beta will be the same, okay? Where a company does not have debt in its capital structure, it means that equity beta and then asset beta will be the same, all right? So that is that. Then the last one we need to talk about in terms of a terminology is the proxy company. Proxy company. Proxy company is also known as comparable company. Okay, it represents the company that are already operating in the industry where the main company is moving to. Like I mentioned the other time, Equity Professional Limited is into education. The company is now diversifying into oil and gas. All right. The companies that are already operating in oil and gas are known as proxy company or comparable companies. Therefore, when Equity Pro wants to execute a project in oil and gas, the equity will need to borrow the beta of the proxy company for the purpose of estimating its own cost of capital. So it is believed that, or it is assumed that both the proxy company and the main company have similar business risk. Okay, they both have similar business risk. So these are the things the terminologies you need to take into consideration. Then, what are the procedures you need to consider whenever you want to calculate project-specific cost of capital? There are basically 5 procedures that you are going to carry out whenever you want to calculate project-specific cost of capital. So let me show you. Should I use this one? Yeah, that's not it bad. Let me see if I can use this formula to explain it. Sorry, this procedure to explain it. Okay, yeah, it's the same thing. So let me just use the procedure you have instead of rewriting it. So let's use this one. All right. So whenever you want to calculate project-specific cost of capital, there are 5 procedures that you need to carry out. The first procedure is to identify the proxy beta. You need to identify the proxy beta. All right. So the proxy beta, how do you identify it? You just go to the question. Of course, the name of the main company will start with a question, or the question will start with the name of the main company. When you see any other name that is different from the main company, that second company represents the proxy or comparable company. At times, examiner may not mention the name of the proxy company, but there will be indication. Examiner must surely give to you the information of the proxy. So once you go to the section of the question and you identify the areas, the information of the proxy company given to you. So from the information, from the data given to you for the proxy, just identify the beta. So of course, examiner can give you asset beta or equity beta. When you are given asset beta, it means that asset beta is on gear beta. But when you are given equity beta, and you can see from the balance sheet or in the capital structure, you can see debt, any form of debt, like bond, loan notes, debenture, or bank loan in the balance sheet of the proxy company. It means that the beta is geared. I will explain further. But for now, let's take it one by one. So that is how to identify the proxy beta. Just go to the balance sheet of the proxy company, pick the beta you have there, put it in your step 1. Then step 2 says you should ungear if the beta is geared in order to remove financial risk. Now, if in step 1, the beta you have identified in step 1 is geared, you need to remove the financial risk because your intention in step 2, your intention is to measure the risk. Is to determine the risk that measure, is to determine the beta that measure the risk of the industry where the company is moving to, which is the business risk. So if the beta of the proxy company is already geared, you need to remove it. Therefore, one thing you should ask is that how would you know that the beta is geared? I've already explained that, but I will explain again. A gear beta is the one in which the proxy company has debt in its capital structure. I repeat again. A gear beta is the one in which the company has debt in its capital structure. Just go to the balance sheet. If you can see any forms of debt, like bond, loan note, debenture, or bank loan, it means that the beta of that proxy company is geared. So if it is geared, then you need to ungear it. So how do you ungear it? There are 2 different formulas you can use to ungear, depending on whether debt beta is given or debt beta is risk-free. So according to Miller and Modigliani, debt beta is assumed to be risk-free. Therefore, there will be no need, okay? There will be no need to use the extended formula. Now, however, if you are told in the question that debt beta is risk-free, let me put, this is the formula you are supposed to use, where debt beta is equal to 0. That is, it's risk-free. Then this is the formula you are supposed to use. BA is the beta assets. BEG is the beta equity of a gear company. E is the equity value of a proxy company. D is the debt value of a proxy company. T is the company tax rates, or is the tax rates of a proxy company. So for step 1 and step 2, or step A and step B, you need the information of a proxy company. Whenever you want to identify the proxy beta or you want to ungear, or in those 2 steps, you need the information of the proxy company. However, if in the question you are told that if you are given debt beta, where debt beta is given, where debt beta is given, then in that case, you need to use extended formula. Using the extended formula, you then say beta assets equal to beta equity of a gear multiplied by equity value divided by equity value plus debt value, 1 minus tax on one side plus debt beta multiplied by multiplied by debt value multiplied by debt value, debt value multiplied by 1 minus tax over equity plus debt, 1 minus tax. Okay, so that is the formula you are expected to use. That's the formula you are expected to use to calculate beta assets whenever you are told in the question that debt beta is given. What's my pen not connecting? What's wrong with you? Okay, it's back. 1 minus tax. Okay, so that's the big formula that you are going to use. On the day, the beauty about this is that on the day of your exam, examiner will give to you one of the 7 formulas you are going to have at the back of your question paper. The formula for this particular formula is there. So good for you. All right. Then after step 2 or step B, you need to move to step 3. Okay. After you have ungeared, you need to regear in order to incorporate financial risk. In step 2, you have removed financial risk because your intention is to calculate beta assets, or asset beta. Asset beta is on ungeared beta, which measures business risk. So you want to calculate you want to determine business risk, and that's why you are calculating beta asset. So you need to remove the financial risk involved in the asset beta, in the beta of that proxy company. All right. That's what we have done in step 2. So in step 3 now you want to calculate the weighted average cost of capital, which is project-specific work. So in this case, if the main company has debts in its capital structure, certainly you need to incorporate financial risk into the cost of capital that you want to calculate. Remember what I told you initially, that project-specific cost of capital it should be determined in order to, should be calculated when a company is diversifying, because cost of capital should be consistent with the risk associated with the project. There are 2 types of risk. We have business risk and also financial risk in relation to cost of capital. Okay, so that is for that. Now, how do you regear? From step 3 to step 5, you need the information of the main company. You need the information of the main company. That is, whenever you want to regear, whenever you want to calculate CAPIMs, whenever you want to calculate your project-specific work, you need the information of the proxy company. You need the information of the proxy company, of the main company. Now, when you want to regear, all right, when you want to regear, you need, like I mentioned, you need the market value, or you need the value of equity, value of debt, and then the tax of the main company. Now, depending on whether, when you want to regear, depending on whether debt beta is given or debt beta is risk-free. So where debt beta is risk-free, okay, where debt beta is equal to 0. This is the formula you're expected to use to regear. Beta equity of a gear, that's what you want to calculate. The beta asset you have calculated in step 2 into 1 plus 1 minus tax of the main company multiplied by debt equity proportion or debt equity ratio of the main company. Okay? So this is not raised to power D over E. No, it is multiplied by debt equity proportion. At times, the debt equity proportion could be 30. If debt is 30, then equity will be 70. All right? So, but in any case, that is for that. But where debt beta is given, okay? Where, let me write that. Where debt beta is given, then all you need to do is to repeat the formula in step 2. Just repeat the formula in step 2 by saying the beta assets equal to beta equity of a gear company multiplied by equity value divided by equity value plus debt value 1 minus tax on one side plus debt beta of the main company multiplied by debt value of the main company multiplied by 1 minus tax. All of that divided by equity value plus debt value of the main company multiplied by 1 minus tax. Okay, so that is the formula. The difference now is that you can see it's the same formula you have in step 2 and step 3 where debt beta is given. The only difference is just that in this step 2, you need the information of the main company. In step 1, you need the information of the proxy company. Okay, so that's the difference between the two. Then once that is done, you then move to step 4, which is to calculate cost of equity using capping. All right, calculate cost of equity using capping. KE is cost of equity. ROF is the risk-free rate of return. Beta equity you've computed in step 3. RM is market return. Then RF, of course, is risk-free rate. So the difference between market return and the risk-free rate of return is called market risk premium. Okay, this is called market risk premium. Okay, so because at times examiner may not give to you the RM, market return, so you are going to be given risk premium. So just note that the difference between market return and the risk-free rate of return is called risk premium. Okay, then finally we move to step 5. Step 5 says you should calculate project-specific WACC. So the normal way you calculate your WACC, there's nothing different. So it's the same thing. All right, you already know this formula. We have used it severally. Okay, so these are the procedures that you're expected to carry out whenever you want to calculate project-specific cost of capital. I repeat, you can see the acronyms I put here. That's it. Whenever you want to calculate, the P stands for proxy beta, U stands for ungeared, R stands for regeared, C stands for capping, then W stands for WACC. Okay, so that's it. That's the formula. Let me know if you have any question before we solve illustration. All right. Let me know if you have any question. Okay, so let's go for illustration. Remember what I told you. You only calculate project-specific cost of capital when a company is diversifying. So today we are going to solve only one illustration under cost of capital. However, as we proceed to, when we get to capital budgeting, there are two different there are two different questions that we are going to solve that involve project specific under capital budgeting. So when we get there, we are going to do it. Then again, under valuation, there's one question there that relates to project specific cost of capital. So when we get there also, we are going to solve it. So making four different questions under project specific. Yes, let's solve this illustration number 20, please. I will need somebody to read for us. Who will take the lead? Okay, let me welcome Awele. Awele, can you read for us?
Illustration 20. Sorry, can you hear me?
Yes, I can hear you loud and
Yes.
clear.
Kilimanjaro PLC produces domestic electric heaters. The company is considering diversifying into the production of freezers. Data on four listed companies in the freezer industry and for Kilimanjaro are shown below.
Okay.
The par value per ordinary share is 25K for Mississippi and Zambezi, 50K for Nile, and 1 naira for Limpopo and Kilimanjaro. Corporate debt may be assumed to be almost risk-free and is available to Kilimanjaro at 0.5% above the Treasury bill rate, which is currently 9% per year. Corporate taxes are payable at the rate of 35%. The market return is estimated to be 16% per year. Kilimanjaro does not expect its gearing to change significantly if the company diversifies into the production of freezers. You are required to A. Estimate what discount rate Kilimanjaro should use in the appraisal of its proposed diversification into freezer production. Corporate debt is often assumed to be risk-free. Explain whether this is a realistic assumption and calculates how important this assumption is likely to be to Kilimanjaro's estimate of a discount rate in A above. For this purpose, assume that Kilimanjaro and the four freezer companies all have a debt beta of zero point 0.3. C. Discuss whether systematic risk is the only risk that Kilimanjaro shareholders should be concerned with.
Yes, thank you very much. Awele, that is the question. So in the A requirement, examiner is asking you to estimate what discount rate Kilimanjaro should use in the appraisal of its proposed diversification into freezer production. Like I've explained to you in our previous classes, whenever you are given a question, always start from the additional information, sorry, from the requirements. Always start from the requirements because the requirement will prepare your mind on the expectation of the examiner. In this question, the examiner wants you to calculate, to estimate the discount rate that Kilimanjaro should use in the appraisal of its proposed diversification. Examiner has mentioned diversification in the requirements, all right? So something should call your mind that, okay, this may likely relate to project specific. Okay, then you go to the body of the question. From the first paragraph, examiner told you that Kilimanjaro PLC produces domestic electric heaters. The company is considering diversifying. Okay, examiner has also mentioned diversifying into the production of freezer. So, because as you are reading it, you need to underline so that you know, you need to satisfy the examiner's requirement and the expectation. Okay, so now that you know that the company is diversifying, then and you have to estimate appropriate cost of capital. You need nobody to tell you that this is project specific cost of capital. Not only that, the main company in this question is Kilimanjaro. Examiner has given to you four different proxy companies, another different names. So that's another indication. Is that once you have the different names of companies in a question, and you have to calculate cost of capital, another thing you can another indication is that different names will be given to, like in this case now, At times, it could be only one proxy company, but in this particular question, we are given 4 different proxy companies. So without wasting more time, let's solve. We've already identified from the question that we want to calculate project-specific cost of capital. So I will stop sharing this and move to the working notes. So solution to illustration number 20. So the name of the company is Kilimanjaro PLC. So examiner asks us to compute cost of capital. You have to estimate what discount rates Kilimanjaro should use in the appraisal of its proposed diversification into freezer production. So I would then say Roman figure number 1, calculating, because we have identified from the question that we need to calculate project-specific work because the company is diversifying. Therefore, I would then say calculating project-specific cost of capital. Okay. So now I told you there are 5 procedures. If I like, as a student, I can come here. I'll just write proxy beta, ungear, regear. What's wrong with you? Ungear, regear, cap it, then work it. I have 5 procedures that I'm going to carry out. The first one is proxy beta. There is no need for you to come and say, identify proxy beta. You don't need all those ones. Just come here and say proxy beta. You then go to the question. What is the proxy beta? Let's go back to the question. Open to the question in your at your hand. So when you look at the table given to you, the last line item on the table is beta equity. You are given beta equity of the proxy companies. There are 4 different proxy companies: Mississippi, Limpopo, Zambezi, then Nile. There are 4. Those are the 4 freezer proxy companies. So if that is the case, I will then come here, beta. There are 4 of them, one for Mississippi, plus the one of Limpopo, plus beta of Zambezi, plus beta of Nile. There are 4 different companies. Then you find the average because you need only one beta. Now examiner has given you 4. You need to find the average. Therefore, according to the question, the beta equity of Mississippi is 1.4. Here is, sorry, 1.10 plus 1.25 plus 1.3, 1.30 plus 1.05. So you add everything together, then you divide it by 4. Therefore, the proxy beta is equal to, let me see, 1.1 plus 1.25 plus 1.3 plus 1.05 equal, that's 4.7 divided by 4. 1.175, that's 1.18. 1.18, because the beta given to all in the question are in 2 decimal places. So your answer should also be in 2 decimal places. Then number 2, step number 2, we need to ungear. You will only ungear if the beta of the proxy company is geared. So I don't need to write down my formula. I don't need to write anything in step 2. I need to first of all go to the question and check this equity beta given to us, whether it is geared or ungeared. And I told you that the beta of the proxy will be geared if the proxy company has debt in its capital structure. You will notice that in this table, examiner has given to you bank loans, for the proxy companies. So which means that the beta of the company, of the proxy companies are geared. So we need to ungear it. So I would then say ungear. So there is no need for you to say ungear in order to remove financial risk. You don't need to do all of that. Just move on. You don't have time. Just do what you need to do. The next thing I need to do before I put down my formula, I need to check from the question whether I'm given debt beta or debt beta is risk-free. So when Awele was reading the question, there's nowhere we are given beta except in requirement number 2, where you are given debt beta of 0.3. So all throughout the question, we are not given any debt beta. Therefore, it is assumed to be risk-free. Okay, it is assumed to be risk-free. Debt beta is not given. Debt beta is between 0 and 1. So, but we are not given. So I will just come here. Beta assets is equal to beta equity of a gear multiplied by equity value plus debt value. Sorry, what am I saying? Equity value divided by equity plus debt, 1 minus tax of the proxy company. So this is the formula you use for the proxy company whenever you want to determine beta assets. So as a result, the beta equity of a gear is equal to 1.18. 1.18 multiplied by equity value of the proxy company. So we need to go and estimate the equity value. We are not given equity value. Okay, so that is market value of equity. We need to determine market value of equity, market value of debt of the proxy company. So I've already shown you how to calculate market value of equity and market value of debt when we had traditional work. So I will leave this page for the main, for this page will be page 1, page 2, page 3. Then I will go to page 4 for my workings. Okay. Working number 1, I want to calculate market value. All right. Market value of equity first. Before I put down my formula, I need to go to the balance sheets. I want to know, am I given number of shares or I'm given share capital? That will determine on the formula that I'm going to use. According to the question, we are not given number of shares. We are only given share capital. When you look at in the balance sheet, under the finance by, the first item is bank loans. The next one is ordinary shares. So 4,000, 9,035.53. So that represents the share capital, not
Yes, sir.
number of shares.
Hello,
Who's
sir.
talking? Yes, Wumi.
It's Omobi. Yeah, please, what page are you on the material?
That's page 34.
Okay, thank you.
You're welcome. Okay. Now, we are given share capital. Therefore, we cannot use the formula to use to calculate the value of equity would then be share capital divided by nominal price. Nominal price is the same thing as par value or book value or face value. So examiner has used par value in the question. So let's use what the examiner used. So par value multiplied by, in this case, when you are calculating project specific, you are less concerned with ex-div share price, all those stuff, because we don't need dividend in this case. So we don't need dividend. So just put share price. Now, for Mississippi, The share capital of Mississippi, according to the question, is 4,000 naira. Okay, 4,000. So I will say 4,000 divided by, when you divide share capital with the par value, what you are trying to do is to determine the number of shares. So what's the par value of Mississippi? Give it to me. What's the par value of Mississippi?
25 kobo.
25 kobo. Thank you. So 0.25 multiplied by the share price. I need the share price of Mississippi. In the question, are you given share price? When you look at the information given to you, you are given earnings per share, you are given dividend per share, you are given price earning ratio. So the share price is not given to you. You are not given the share price of the companies, but there are information that the examiner has given to you information that will enable you to compute the share price. Let me demonstrate this for you. You remember, for those of you that did not job fence, those of you that are coming from skills level, you have done financial statement analysis, which is you also have a ratio analysis. In ratio analysis, you would have been taught that price earning ratio is computed as share price divided by earnings per share. All right. So this share price that you have as the numerator is the market value per share. All right. It can be called market value per share, or it can be called share price or market price per share. Now, if the share price is not given, then all you need to do is to just cross multiply by saying that share price equal to earnings per share or price earning ratio, price earnings ratio multiplied by earnings per share. So this will give me the formula of share price. Okay, this will give you the formula of share price. So in this particular question, examiner did not give to us the share price, and that is the formula we are going to use to get the share price. So I can come here by saying that is price earnings ratio multiplied by earnings per share. Okay, so for Mississippi, I would then go to the question, what's the price earning ratios of Mississippi? Please, let's contribute. 12 times. 12 times, here is 12 multiplied by, what is earnings per share of Mississippi?
Mississippi.
25 kobo. 25 kobo is earnings per share of Mississippi. That's 0.25. 0.25. So you multiply 12 multiplied by 0.25 equal to 3 naira. So here will be 3 naira. So our figures are in thousands. Multiply 4,000. 3 multiplied by 4,000 equal, sorry, it's an error. 4,000 divided by 0.25 equal, then multiply by 3 equal 48,000. So 48,000 is the market value of equity of Mississippi. Then the next one, the next proxy company is Limpopo. I will then go back to the balance sheet, capital structure. What is the share capital of Limpopo? The share capital of Limpopo is 9,000. Okay, what is the par value of Limpopo? The par value of Limpopo is 1 naira. So here is 9,000 divided by 1 naira multiplied by share price. I don't know the share price. I need to work it out. So I will then go to the balance sheet again with the information given to me. What is the price earning ratio of Limpopo? 10 times. Then what's earnings per share of Limpopo? The earnings per share of Limpopo is 53.3. Okay. I said price earning ratio is 10 times. Okay. Here is 10 multiplied by, remember, the price earning ratio is in kobo. So please don't make mistake. So 53533. So multiply by 10. This will be 53. It will be 5.33. All right. So 9,000 multiplied by 5.33 equal. That's 47,970. 47,970. Then you do for Zambezi. For the Zambezi, share capital of Zambezi is equal to 3,500. The par value of Zambezi is 25 kobo. All right, so 35 divided by 0.25. I don't know the share price. I need to work it out. What's the price earning ratio of Zambezi? 9 times. Earnings per share is 38.10 kobo. Okay, sorry, 38 kobo. 38.1 kobo, rather. So in that case, I would then come here. That's 9 multiplied by 0.381. 9 multiplied by 0.381. So give it to me. 0.381 multiplied by 9 equal. That's 3.429. Here is 3.429. 3.429 multiplied by 14,000. That's 48,006. 48,006. Then finally, I need to calculate market value of equity for Nile. So for Nile, share capital of Nile is 5,300. The par value of Nile is 50 kobo. Here is 5,300. 5 kobo or 50 kobo multiplied by, I need the price earning ratio and the earnings per share of Nile. Okay. Yes. Price earning ratio of Nile is 14.
14.
Earnings per share is 32.3. That's 0.323. All right. 14 multiplied by 0.323. So let's multiply. 0.323 multiplied by 14 equal 4.522. Here is 4.522. 10,600 multiplied by 10,600. That's 47,933. 47,933. So we are done. So add everything together. Add everything together, please. Total market value of equity of proxy. What do you have? What's the total? Are we still together?
189,909.
One,
189,909.
Do it again.
191909.
Okay. 191,191,909.
191909.
So that's the total market value of equity of the proxy company. So the next thing you need to do is to determine the market value of the debt. Okay? Determine the market value of the debt. D, which is debt. When you look at this question, examiner gives to you the bank loan of the proxy companies. There's no market value for bank loan. Remember, I told you there are two types of debts. We have traded debts and then non-traded debts. The traded debts are the fixed income security that can be bought or sold in an organized financial market. They are tradable, all right? Those are traded debts. Examples of traded debts include bonds, debenture, loan notes. The non-traded debts are securities that cannot be bought or sold in an organized financial market. They are not tradable. Examples include bank loan as well as overdraft. So you cannot, there's no market value. There's no market value for bank loan because it's not tradable. You can't buy it, you can't sell it in the market. It's not possible. Therefore, the book value of the bank loan is what you are going to add together. So you had the debts, the bank loan of Mississippi plus that of Limpopo, Zambezi, and then Nile. So in this case, D will be equal to what's the book value of the debts of Mississippi? 5,300 plus the debt of Limpopo,
12,600.
12,000.
12,600. Zambezi,
18,200.
18,200. Then I
4,000.
4,000. So let's add everything together. What do you get?
40,100.
40,100 is the total value of debt. So we have gotten E and D. So we have gotten E and D, that is value of equity and value of debt. So let's go back to our main calculation. You can see for the past between 5 and 10 minutes ago, we could not continue because the information that we need is not available in the question. And that's why we have to go and do our workings first. This is what is expected of you on the day of your exam. Therefore, beta assets is calculated as 1.18, that's the beta equity of a year, multiplied by equity value of the proxy is 191,909 divided by 191,909 plus value of the debt, which is 40,100 into what is the tax rates of the proxy company. In this question, the examiner did not separate. You are given tax rate of 35%. You are not told whether it is for proxy or for the main company. So that means the two of them will use the same tax rates. The same tax rate we apply for the two of them. So 1 minus 0.35 will give us 0.65. So on the day of your exam, there is no need for you to come and be saying 1 minus 0.35. It's a waste of time. You already know 1 minus 0.35 is 0.65. Just put 0.65 there and move on to the next one because you don't have time. Okay? Then beta assets equal. Then bring out your calculator. Give me the final answer. What do you have? Start from the denominator, 0.65 multiplied by 4,100 equal plus 191,909 equal 191,909 divided by answer equal multiplied by 1.18 equal. Give me the final answer. What do you have there? Final answer? Yes. You are not cooperating. What's the final answer? Okay.
1.0.
1 point what?
50.
1 point
50.
04.
no 04. 1.04 is the answer. 1.04 is the answer. Then I will go to step 3. Step 3 says we should regear to incorporate financial risk. So you regear. Again, there's no need for you to say regear to incorporate financial risk. Just do what you need to do. All right. Since that beta is assumed to be risk-free, then the beta equity of a gear will be calculated as 1 plus 1 minus tax, debt equity proportion. Okay. Let me manage this space so that I don't move to the next one. Equal to 1 plus 1 minus tax of the main company multiplied by debt equity proportion of the main company. Okay, so beta equity of a gear is equal to 1 plus 0.65. 1 minus 0.35 is the same thing as 0.65. Now, I need to go and calculate the value of debt and value of equity of the main company, which is Kilimanjaro. So let's do the same way you did for the proxy company. So for Kilimanjaro, PLC. Equity value is equal to, what's the share capital of Kilimanjaro? 4,000. The par value is 1 naira. Here is 4,000 naira divided by 1 naira multiplied by the price earning ratio of Kilimanjaro is 8 times. Earnings per share is 106. So here is 8 multiplied by 1.06. Okay? 8 multiplied by 1.06 equal to 8.48. So 8.48 multiplied by 4,000, number of shares, that's 33,920. Here is 33,920. So what's the value of debts? Value of debt of Kilimanjaro. The bank loan of Kilimanjaro is 17,400. $17,400. So I need to get the total value because we are going to use that one for when we want to calculate the WACC. Therefore, total value will then be equal to value of equity plus value of debt of Kilimanjaro, which is 33,920 plus 17,400. This will give us 51,320. That's the total value of Kilimanjaro. So let's go up there. So value of debt is 17,000 400 over value of equity 33,920. Okay, final answer. What do you have there? So bring out your calculator. 17,400 divided by 33,920 equal, multiply by 0.65 equal, plus 1 equal. That's 1.33. I got 1.33. What do you have at your end? Is it the same thing? Because I'm using my PC calculator. Yes. What do you have? Is it the same thing as 1.33?
Yes.
Okay. Step 4 now. We need to calculate cost of equity, capping, denoted as KE. So KE equal to risk-free rate of return plus beta value in step 3 multiplied by market return minus the risk-free rate of return. So cost of equity equal. Then go to the question, what's the risk-free rate of return given to us? What's the risk-free rate of return given to you? Given to you. When you go to the second paragraph after the table, you are told that corporate debt may be assumed to be almost risk-free and is available to Kilimanjaro at 0.5% above the treasury bill rate, which is currently 9% per year. So treasury bill rate is 9%. Cost of debt, the KD in the formula for calculating WACC is 0.5 above treasury bill of 9%. So which means that KD is 9.5%, treasury bill is 9%. Treasury bill is the rate of return associated with government security. One of the government securities is treasury bill or government bond. All right. So that's the risk-free rate of return. Why is it risk-free? What that simply means is that your money is secure. Your investment or your initial investment is secure. Even your interest as well will be paid. Government is continuum. You can't lose your money when you invest in government security. All right. So let's move on. Then if risk-free rate of return is 9%, what is market return? So according to the question, the market return is estimated to be 16% per year. So let's go there. Here is 9% plus beta of 1.33. We computed in step 3. Market return is 16 minus risk rate of return of 9. Okay, so cost of equity is equal to 7. Difference between 16 and 9 is 7 multiplied by 1.33 equal plus 9 equal 18.31. Here is 18.31%. Okay. Then finally, step 5, you need to calculate project-specific WACC. So you calculate WACC, denoted as KW. Therefore, WACC is computed as equity value divided by total value, equity plus debt, cost of equity plus debt value, equity plus debt, cost of debt, multiplied by 1 minus tax. Remember what I told you when we started. You can't do anything in SFM if you cannot memorize formula. So that's one of the uniqueness of SFM. It is formula driven, and you must be willing and ready to memorize formula at all time. If you can't do that, so that means you are not ready to qualify. Please. develop the interest. Just develop the interest. That's your starting point. Memorize formulas. Okay. So KW, equity value we calculated is 33,920. Total value we calculated is 51,320. Cost of equity we just calculated is 18.31% on one side, plus the value of the debt is 17,400. Total value is 51,320. Multiplied by cost of debt. The KD, examiner told us that corporate debt is almost assumed to be, is assumed to be almost risk-free and is available to Kilimanjaro at 0.5% above treasury rate, which is currently at 9%. Treasury rate is 9%. 5.5% above 9% means 9 plus 0.5, which is 9.5. So here is 9.5%. Then multiply by 1 minus tax. 1 minus tax is 0.65. Okay. So from the left, give it to me from the left. What do you have there? 33,920 divided by 51,320 equal, multiply by 18.31 equal. Give it to me. Yes. Are we still together? Are you guys still there? Or you are attending this class in proxy?
We are calculating.
Only two people have been talking since. Every other person has been muted. This is not good. I told you earlier today when I was chatting you need to cooperate with me. Other than that, we are going to extend this class to the next one because you are slowing down the class. In any case, 33,920 divided by 51,320 equal, multiplied by 18.31 equal. That's 1210. 12.10% plus from the other side 17,400 divided by 51,320 equal, multiply by 9.5 multiply by 0.65 equal 2.09. 2.09%. When I add the two together, that will give me 14.19%. Okay, 14.19%. That's it. All right. So that's it. This is how to calculate project specific work. I can say approximately 14%. So the work of Kilimanjaro is approximately 14%. So let me know if you have any question for me before we move to the next requirement of the question. Any questions so far? Okay, let's move to number 2. The second requirement of the question, examiner is asking that corporate debt is often assumed to be risk-free. Explain whether this is a realistic assumption and calculate how important this assumption is likely to be to Kilimanjaro's estimate of a discount rate in A above. For this purpose, assume that Kilimanjaro and the 4 visa companies all have a debt beta of 0.3. In this requirement number 2, there are 2 things you are going to do. One is to explain if truly corporate debt is risk-free. Then 2, examiner has given you debt beta of 0.3. That means you need to recompute your cost of capital. indicating the debitor. So that's the two things you are going to do in the requirement number 2. Now, how do you then explain to the examiner? Examiner is asking you, corporate debt is often assumed to be risk-free. Explain whether this is a realistic assumption. Is it true that corporate debt is risk-free? When you say corporate debt is risk-free, what we are saying is that when you borrow somebody, when a company borrows another company money, then there is certainty that the company will recover the principal, even the interest will be paid. All right. That means there is no risk attached. Is it true in reality? That's what the examiner is asking you, that if you borrow somebody's money, you are going to get your money back. All right. So you need to
No, it's
explain.
not true.
So examiner is asking you if it is true. If it is not true, then you need to explain. What do you mean that it is not true? If it is true, why do you say it? Why do you say so? So you need to explain. Now, when you talk about to answer this, I will answer in 2 different ways. I will answer this in 2 different ways. You know, when you say a company is distinct from the owner, okay? A company is different or is separate from the owners. When a company owes money, you cannot use the assets of the owners to settle the liability of the company. That's not possible because of that separation between the owners and the business. The liability of the owners of the business is limited to the capital contributed. Therefore, when a company liquidates, the company is unable to carry on a going concern basis. So when a company liquidates, the assets of the business will be realized, will be disposed of, and the liability therefrom will be settled. All right. So if at disposal, the proceeds realized is not sufficient to cover the liability, what will happen? Who will pay the remaining balance of the debt? Nobody. It means that debt is gone. The outstanding balance is gone. Nobody will pay it because you cannot use the assets of the owners to offset the liability of the company. That's not possible. All right? Because every company is a legal entity. All right? So that is, on that note, we cannot say corporate debt is risk-free. Another point that you can use to buttress, to explain this requirement is that, when there's a default risk is the risk arising from inability of a company to pay both the interest and then the principal and the principal. When a company is unable to pay its debts, then that means we're saying the company is defaulting. So when there is default risk, part of the debt or part of the investment or the entire investment may be lost as a result of that. So when that happens, can we say corporate debt is still risk-free? No, it is not. Because if somebody defaults, the worst the company can do is to sue. Of course, there will be litigation, and they'll begin to drag it. Years you can be there. You still be dragging it in the court. All right. I will tell the company might say, okay, I don't have the means now. That's what I've not been able to pay the business and business has been bad and this and that. Okay. When do you want to pay? Okay, I will be paying it every year. I'll be paying so much. We'll continue to drag it. All right. So this is what we are saying now. So once there is default risk, the part of the investment or the entire investment may be lost as a result of that. And yeah, so for this purpose, we cannot say corporate debt is risk-free. It is only on paper, it's only on theories, and it's a mere assumption, not in practice, not in practice. All right. So that is the answer to that one. Okay. Then to the second part of requirement number 2, you are expected to compute the project specific, you expected to compute your cost of capital using the debt beta of 0.3. Quickly, let's do that. Number 2B now. Requirement number 2B. Okay. This is for explanation, which I have done. Then 2B. So we need to recalculate. Calculating project specific cost of capital. Don't go and be writing PSCOC on the day of your exam. You have to write it out in full. So calculating project specific cost of capital, where debt beta of 0.3 is given. Okay. So there is no need for me to say identify the proxy beta. I've already seen the beta. 0.3 is what is given. Okay. Therefore, the next thing I need to, let me just put it there. Step 1, proxy beta equal to 1.18 is the same beta we have done in the first requirement. Then step 2, you need to ungear the beta. Ungear. Now, since I'm given the debt beta, I'm going to use the big formula to ungear. So I would then say beta assets equal to equity value, sorry, equal to, beta equity of a gear multiplied by equity value over equity plus debt, 1 minus tax on one side, plus debt beta multiplied by debt value multiplied by 1 minus tax divided by equity value plus debt value 1 minus tax on the other hand. Okay. So I would then say beta assets equal to 1.18. Equity value of the proxy company is 191,909 over 191,909 plus debt value, which is 4,100, 0.65, 1 minus tax, plus debt beta is 0.3 multiplied by debt value 4,100 multiplied by 0.65 divided by equity value 191,909 plus 4,100. Let me manage that space. 4,100, 0.65. Let me write that. 0.65. Oh, that's too close. Okay. So beta assets, we have done the first part. This one gave us 1.04 plus the other side. I would then say 0.65 multiplied by 4,100 equal plus 191,909 equal, that's 217. Here is 217,974. 217,974. Since you are not ready to give me number, no problem. 0.65 divided by 40,100 equal, divided by 217,974 equal, multiply by 0.3. Something is wrong. 40,100 divided by 0.65 equal, oh, mistake. 4,100 multiplied by 0.65. I use division. Then divided by 217,974. Okay, equal. All right, 217. Oh, that's not correct. 40,100 multiplied by 0.65. Yes, divided by 217,974. Okay, yes, correct. Multiply by 0.3 equal 0.04. Here is 0.04. So beta asset is equal to 1.08. That's it. That's it. Then step 3, I need to regear. So since debt beta is given, to regear, all I need to do is to repeat the formula in step 2. Therefore, beta assets equal to beta equity of a gear multiplied by equity value over equity plus debt 1 minus tax plus debt beta of the main company tax debt of the main company into 1 minus tax of the main company divided by equity plus debt 1 minus tax. Okay, so in step 2, we use the information of the proxy company. Then in step 3, we're expected to use the information of the main company, which is Kilimanjaro. So beta assets, we calculate beta asset to be 1.08. We are looking for beta equity of a gear. We don't know it yet. So equity value of Kilimanjaro is 33,920. 33,920 plus debt value of 17,400 into the two companies, both proxy companies and then the Kilimanjaro, they have the same tax rate of 0.65. Plus, again, examiner told us to assume that the two companies, both the proxy companies and Kilimanjaro, have the same debt beta. In most cases, if you are not given the debt beta of the main company, you are going to assume it is risk-free. It is only when you are given the debt beta of the main company that you are going to use this big formula. Okay, so here is 0.3. Debt is 17.4 into 0.65 over 33,920 plus 17.4.65. Okay, so 1.08 equal to beta equity of a gear. Then, of course, 0.65 multiplied by 17,400 equal plus 33,920 equal, oh, mistake.
45 to 30.
Pardon?
45 to 30.
Okay, so this one will give us 0.75 BEG. This is supposed to be 0.75 BEG plus the other side, which is 0.65 multiplied by 17,400 equal plus 33,920 equal 45,230. Okay, 45,230. 17,400 multiplied by 0.65 equal divided by 45,230 equal multiplied by 0.3 equal 0.075. Here is 0.075. So all will I need to do now is to collect like terms. All right, I can say 0.75 BEG equal to 1.08 minus 0.075. Therefore, BEG equal to 1.08 minus 0.075 equal 1.005. 1.005 then divided by 0.75. So this gives divided by 0.75. That's 1.34. Here is 1.34. So the beta equity of a gear of Kilimanjaro is 1.34. Therefore, I'll move to step 4, which is capping cost of equity. So KE equal to risk-free rates. I don't need to rewrite our formula again. Something we have done is in the first requirements. So just put in figure. Here is 9 plus 1.34. The difference between market return and the risk-free rate is 7. So final answer here. So 1.34 multiplied by 7 equal plus 9 equal 18.38%. Okay, finally I calculate WACC. Again, there's no need for me to write our formula. So equity value of the main company is 33,920. Total value is 51,320. Cost of equity of the main company we just computed is 18.38% on one side, plus the debt value of 17. In fact, we have calculated the other part of the formula, which is 2.09, but let's put it again. Here is 17,400 divided by the total of 51,320 multiplied by 9.5% multiplied by 0.65. Okay, on the other side. Therefore, oh, okay, final answer will be here. So I would then say 33920 divided by 51,320 equal multiplied by 18.38 equal 12.15. Here is 12.15% plus 2.09%. So this is equal to, that's 14.24. Here is 14.24%, approximately 14%. This shows that when you introduce corporate debts, when you produce debt beta, then there's a marginal error between the cost of capital we computed where there is no debt beta and where there is debt beta. Okay. All right. So that's for number 2 requirement of the question. The last one The last part of the question is you have to discuss whether systematic risk is the only risk that Kilimanjaro shareholders should be concerned with. Of course, first thing first, before you can answer the question, you must know what is systematic risk, what is unsystematic risk. When we get to when we get to portfolio theory, I will explain to you in details the portfolio risk, including the systematic and then unsystematic risk. However, this is an exam question. So examiner is asking you to discuss whether systematic risk is the only risk that Kilimanjaro shareholder should be concerned with. Of course, every company will be concerned with the total risk that affects the business operation. So when you talk about total risk, it means both systematic and then the unsystematic risk. So systematic risk is the risk that affects every business in the economy, irrespective, all right? Everybody will bear the brunt of systematic risk when it arises. You remember what happened in 2020 during COVID-19? Every businesses around the world suffer the consequence of COVID-19. This is what is known as systematic risk. When there's inflation, every businesses in the economy will suffer the impact of inflation. So that is an example of a systematic risk. Not only that, when there's changes in interest rates, when interest rates increases, except if you don't buy or you don't sell things, once you buy, you are going to feel the impact of changes in interest rates. So then when you talk about unsystematic risk, is the risk that is peculiar to a particular company in the or industry. So the systematic risk is avoidable and it is also diversifiable. Now, both the systematic and then the unsystematic risk should be the shareholder. All you need to, after you have explained what is systematic, what is unsystematic, then you can then say the shareholders of Kilimanjaro PLC should be concerned with the total risk that affects the business operation. That's all. That's it. That answers the question. So let me know if you have any query or question for me so that we move to Wakuka. Yeah, we still have about 1 hour or thereabout. So let me know if you have any question. If not, then I will stop sharing and move to the question bank. Okay. So let's talk about weighted average cost of capital of the combined activities. So that's the last part of cost of capital we are going to discuss. Again, we are done with traditional work. We just finished discussing project-specific work. The last part is the weighted average cost of capital of the combined activities. Therefore, what is WACOCA? WACOCA is computed when a company is engaged in several activities at the same time. So instead of using different cost of capital to appraise or to evaluate each project or each activity, a cost of capital that will be suitable, all right, to appraising all the projects should be estimated, all right. That is what is called WACOCA. For example, a company may be into education as well as a communication business, all right. So when you want to appraise projects in education, you use one cost of capital. When you want to appraise projects in real estate, for example, you use another cost of capital. That is not appropriate. So that's why we are saying that you should be able to use only one cost of capital that will be suitable to appraise all the activities or to evaluate all the activities or projects. So this is what is known as a weighted average cost of capital of the combined activity, which I called WACOCA. Whenever you want to compute WACOCA, there are 7 procedures you are expected to carry out. Let me see if I have them here. Okay. All right. This step 4 here. Okay. It's okay. Let's manage this. If there's any area I need to chip in, then I will come in. All right. So there are 7 procedures that you need to carry out whenever you want to calculate WACOCA. All right. The first step that you need to carry out is to identify the beta of each activity. Okay. You identify the beta of each activity. Like I mentioned the other time, a company may be operating in education business at the same time having a communication business. So those are 2 different activities. So what is the beta in education? What is the beta in communication? So that means you have identified the beta. Then once you have identified the beta in each activity, then you move to the second step. Second step says you should ungear the beta. The same way you ungear the beta when you normally do under project specific is the same way that you are going to do here, depending on whether you are given dead beta or dead beta is risk-free. So where dead beta is risk-free, this is the formula you are supposed to use to ungear. Where dead beta is equal to 0, you use this formula. But where dead beta is given, okay, where dead beta is given, then of course you need to use the extended formula, which is the beta assets equal to beta equity of a gear multiplied by equity value over equity plus debt, 1 minus tax. Okay, on one side, plus debt beta multiplied by debt value multiplied by 1 minus tax over equity value plus debt, 1 minus tax on the other side. Okay, so that's, with this, you have ungeared. Once you have ungeared, then move to step 3, which is to calculate market value of equity, market value of debt of each activity. All right, the same way you calculate market value of equity, you remember. So value of equity is calculated as number of shares multiplied by share price. Value of debt will be calculated as nominal value multiplied by interest divided by 100 naira, because debt is always quoted at 100 naira per unit. So you go ahead and calculate market value of equity. You also calculate market value of debt. Okay, debt can be in the form of bonds, debenture, loan note, or even bank loan. Okay, if it is bank loan, you can't use the same formula. You can't use your book value that you are going to use for your bank loan. This is for market value. All right. Okay. Now, that is for step 3. Then in step 4, you need to determine weighted average of the asset beta. You need to calculate asset beta of the combined. Okay. You calculate asset beta of the combined. All right. So to get the asset beta of the combined, asset beta of the combined will be calculated as asset beta of the first activity, okay, multiplied by total market value of equity and debt. Total market value of equity and debt of the first activity divided by total market value of equity and debt of the first and then second activity. We keep it on one side. Okay, we keep it on one side plus, open a bracket, beta assets of the second activity multiplied by total market value of equity and debt of the second activity divided by total market value of equity and debt of the first and then second activity on the other side. Okay? Then, of course, we put it in the formula, we get your final answer. That's it. With this, you have calculated the vital asset of the combined. Okay? Use this formula instead. Cancel this. Use the other one I just showed you. That one is more explanatory. Okay, then. Then, step 5. Step 4. Step 5 says you should regear to incorporate financial risk. Okay, so you incorporate. So from step 1 to step 4, pay attention. From step 1 to step 4, you are going to be using the information of each activity. But from step 5 to step 7, you will use the information of the company. That is the value of equity and value of debt of the main company, including the tax of the company. So that's what you need to do. When you want to regear, it's the same formula you regear. This formula will be used where debt beta is risk-free, that is equal to 0. But where debt beta is given, you need to use the big formula, the big for nothing formula. This big one is what you are going to use. All right. But for now, let's move on. Then once you have regeared, then you move to step 6, which is to calculate weighted average, which is to calculate capping, cost of equity. Then step 7, you calculate WACOCA. So it's as straightforward as that. WACOCA is not difficult. If you know project specific very well, WACOCA is not difficult. No matter how big is the question, it can't be more than these 7 procedures. Just follow it to the latter. The 5 procedure under project specific is embedded in this WACOCA. The only two different things is just step 3 and step 4 that have been included, which is to calculate market value and also determine the vital asset of the combined. So these are the 7 procedures of calculating WACOCA. So with this, let's have illustration. Let me see. Yes, let's have illustration number 19, please. I need somebody to read for us. Illustration number 19. Yes. Who will help us to read? Yes. Who will read for us? Anthony, are you there? Okay, Awele, help us, please.
Illustration 19. Columbia PLC provides training and financial services. The training service accounts for two-thirds of the value of the company. The company has a total debt to total market value ratio of 30%. The average beta and debt to total market value for financial service sector are 0.9 and 25%. The average beta and debt to total market value for training service sector are 1.5 and 12%. Other information includes: A. The equity risk premium is 3.5% and the rate of return on short-dated government stock is 4.5%. B. Columbia PLC can borrow at 2.5% above the risk-free rate. C. Corporation tax is corporation tax is 40% on taxable profit. 4. Assume that debt is risk-free. You are required to estimate the cost of equity capital and weighted average cost of capital for Columbia PLC.
Thank you, Awele. Yes, that is the question. Examiner wants you to compose cost of equity capital and then the weighted average cost of capital for Columbia PLC. So that is it. Now, how would you know this question relates to WACOCA? How would you know it relates to WACOCA? When you look at the first paragraph of the question, the examiner told you that Columbia PSC provide training and financial services. So the training service account for 2/3 of the value of the company, which means that financial service will account for 1/3 of the total value of the company. So with this information, I can categorically tell you that we are supposed to use WACOCA. We're supposed to calculate WACOCA because as this company, Columbia PLC, is into training as well as the financial services. I told you when a company is engaged in several activities at the same time, all right? So the company is into training, is also into financial service. Those are two different activities, all right? So if that is the case, you want to calculate WACOCA. I told you there are 7 procedures. The first procedure is to identify the beta of each activity. Then step 2, you ungear the beta if it is geared. Step 3, you calculate market value of equity and debt of each activity. Then step 4, you calculate beta asset of the combined. Then step 5, you regear. Step 6, you calculate capping. Then step 7, you calculate WACOCA. That's all. That's all you need to do. So let me stop sharing this and move to the working notes so that we can quickly complete the question. Okay. Solution to illustration 19. Columbia PSC calculating WACOCA. Examiner asked us to calculate cost of equity capital and then the WACC. So there's no way you can get your WACC without first of all calculating cost of equity. So denoted as KW. So we are starting from step 1. Step 1 says identify the beta of each activity. I don't need to say activity. I already know the activity, which is training. Beta of training and financial services. Financial F services. So for training, let's go to the question. What's beta of training? According to the question, we are told that in the second paragraph, we are told that the average beta and debt to total market value for financial service sector are 0.9. Beta of financial service is 0.9. In the third paragraph, we are told that average beta and debt to total
Training is
market value of
1.5.
training is 1.5.
1.5.
So 0.9. Here is 1.5. Financial service is 0.9. So I've identified the beta. Step 2 says we should ungear if the beta in step 1 is geared. I will then go back to the question. I want to identify whether this beta of 1.5 and then 0.9 are geared. And I told you that the beta will be geared if the company has debt in its capital structure. According to the question in the second paragraph, we are told that debt to total market value, that is the debt equity ratio. Debt to total market value for financial service is 25%. Debt equity ratio of financial service is 25%. Debt equity ratio of trading service is 12%. Therefore, that beta of 1.5 and 0.9 are geared. If they are geared, then we need to ungear it. Therefore, I would then say ungear. If I want to ungear, which formula am I going to use? Examiner told us in the question that we should assume that debt beta is risk-free. So if debt beta is risk-free, then beta assets, which is ungear beta, is calculated as beta equity of a gear multiplied by equity value divided by equity value plus debt 1 minus tax. Okay, then for training services, beta asset for training, I need to go and calculate. Examiner told us that the debt equity proportion of training is 12%. Debt is 12%. It means equity is 88%. If you are told that if you are given debt equity proportion of 30%, it means debt is 30, equity is 70. If you are given debt equity proportion or debt equity ratio of 60%, it means debt is 60, equity is 40. You must know how to interpret that. So I will then come here for training services. Debt is 12%, equity is 88. So therefore, this one will be 1.5 multiplied by 88 divided by 88 plus the value of debt is 12%. Forget about the percentage. Into what is the company tax rate according to the question? The corporation tax is 40% on taxable profits. So 1 minus 40% will give us 60%. So for training, I would then say 0.6 multiplied by 12 equal plus 88 equal, that's 95.2. So 88 divided by 95.2 equal, multiply by 1.5 equal, that's 1.39. Here is 1.39 for training
0.90.
service. 0. What? Did you say 0.9?
It's 1.39.
Okay. So for financial service, beta equity of a gear is 0.9 or gear beta is 0.9 multiplied by, according to the question is in second paragraph, you are told that the debt equity proportion is 25%. Debt is 25%. It means equity is 77%. Sorry, 75%. Therefore, here will be 75 over 75 plus 25. Tax is 40%. We are accounting for 60%. That's it. Give it to me. 0.6 multiplied by 25 equal plus 75 equal 75 divided by 90 equal multiplied by 0.9 equal 0.75. Here is 0.75. That's the asset beta of training and financial services. I will then go to step 3. Step 3 says we should calculate market value of equity and debt. Okay, market value. The essence of calculating market value of equity and debt is to determine the proportion of equity and proportion of debt in the capital structure. Okay, you are going to use it to weight the beta you have calculated in step 2. Okay, then. So how am I going to calculate market value of equity and debt? According to the question, the examiner has already told you that in the first paragraph, we are told that the training service accounts for 2/3 of the value of the company. So if training service account for 2/3 of the value of the company, then financial service will account for 1/3. So I don't need to go and be doing working for that. So for training, equity value of training is 2/3. Equity value of financial service is 1/3. Okay, then I'll move to step 4. If in the question you are not given this information, you are not given 2/3, 1/3, you need to go and do your working. Normal way you calculate your market value of equity and debt That's the way you are going to get your answer. All right. But examiner has made life easy for us, giving us the market value of equity and debt. So no need to be sweating on this. Then step 4, we need to calculate weighted average asset beta or asset beta of the combined. We calculate asset beta of the combined activity of the combined, that is BAC. How do you do this? I showed you earlier on, beta asset of the combined will be calculated as beta asset of training instead of you to say activity 1. Examiner has told us the activity as training and the financial service. So I will say beta asset of the training services multiplied by total market value of training over total market value of equity and debt of training and financial service on one side plus, open a bracket, beta assets of financial service multiplied by total market value of equity and debt of financial service divided by total market value of equity and debt of training and then financial service. Okay. So beta asset of the combined equal to beta asset of training. We got 1.39 for training. That's what we have ungeared. 1.39. Here is 1.39. Market value of equity and debt of training. Examiner told us 2/3. So this will be 2/3 on one side plus beta assets of financial service is 0.75. Here is 0.75 multiplied by 1/3. That's it. Therefore, I would then say BAC equal to, bring out your calculator, 2/3, 2 divided by 3 equal, multiplied by 1.39 equal, that's 0.93. Here is 0.93 plus 0.75 divided by 3 equal 0.25. You add the two together, beta asset of the combined plus 0.93 equal 1.18.
1.18.
Okay, thank you. So that's step 4. I've then moved to step 5. Step 5 says you should gear to incorporate financial risk. And I told you earlier today that from step 1 to step 4, you are supposed to be using the information of each activity. From step 5 to step 7, you need the information of the company. So whenever you want to regear, you are going to use the value of equity and debt of the main company. Therefore, I would then say beta equity of a gear. Since examiner has told us that debt beta is risk-free, so beta assets multiplied by 1 plus 1 minus tax multiplied by debt equity proportion of the company. Okay, so beta equity of a gear will then be equal to beta asset we have computed in step 4 is 1.18. 1.18 multiplied by 1 plus tax rate is 40%. We are supposed to account for 60%. Debt equity proportion of the main company, of the company itself, according to the question in the first paragraph, you are told that the company has the total debt to total market value ratio of 30%. So debt equity proportion of the company is 30%. Debt is 30%, equity is 70%. Therefore, here will be multiply by 30 over 70. Okay? So beta equity of a gear will then be equal to, bring out your calculator for final answer. So 30 divided by 70 equal, multiply by 0.6 equal, plus 1 equal, multiply by 1.18 equal, that's 1.48. 1.48. That's the beta equity of a gear. Then step 6 rather, we calculate cost of equity, which is capping. So examiner called it cost of equity capital. So I'll just say cost of equity capital. That is capping. Okay. So to get the capping, cost of equity is calculated as risk-free rate of return plus beta into market return minus the risk-free rate of return. That's it. So cost of equity, according to the question, what's the risk-free rate of return? We are told that
3.5%. No,
yes, we are told
4.5%.
that yes. So the equity risk premium is 3.5. The difference between market return and the risk-free rate of return is 3.5%. And the rate of return on short-dated government stock is 4.5. That's the risk-free rate of
Which is the
return.
risk rate? Okay. The risk rate.
Yes, risk-free rate of return is 4.5%. Remove the percentage. 4.5 plus, then the beta we calculated in step 5 is 1.48.
1.48.
The risk premium examiner give to us as 3.5. The risk premium is different between market return and then the risk-free rate. That is the difference between these two. That's the risk premium. So final answer, 3.5 multiplied by
9.7.
1.48 equal, then plus 4.5. That's 9.68. All right. So cost of equity is 9.68%. Then I'll move to step 7. Step 7 says you should calculate WACOCA, denoted as KW. Therefore, WACOCA will be calculated as equity value over total value. Okay. Multiplied by cost of equity plus debt value over total value. Multiplied by cost of debt, 1 minus tax. All of that multiplied by 100%. Therefore, WACOCA equity value, debt is 30%, equity is 70%. If I like, I would just do 0.7 or I just do 70 over 100. If you are doing 70 over 100, it's a waste of time. It's the same thing as 0.7. But for simplicity, let me just say 70 over 100. Cost of equity we computed is 9.68. All right, plus value of debt is 30% over total value 100. Cost of debt, let's go back to the question. Examiner told us that Columbia PLC can borrow at 2.5% above the risk-free rate. 2.5% above 4.5, that's 7%.
7%.
Therefore, that's 7%. Here will be 7%. Tax rate is 40%. We have to account for 60%. All right? We have to account for 60%. So let me just open this. Multiply by 0.60. All right? lest I forget. Notes. KD equal to 2.5% plus 4.5%. KD equal to 7%. Good. Then KW equal multiply 9.68 multiplied by 0.7 equal, that's 6.78. 6.78% plus the other side 0.3 multiplied by 7 multiplied by 0.6 equal 1.26. 1.26%. Add the two together. 1.26 plus 6.78 equal 8.04. 8.04%. Therefore, Wakoka is approximately 8%. That's it. Okay, that's the end of the question. This is how to calculate Wakoka, work of the combined activities. That's how to calculate Wakoka. Let me know if you have any question for me so that we can close the class. So this is where we are going to stop today. Any questions so far?
I have a question, sir.
Yes, talk to me, Wumi.
Okay, why solving the CAPM part? That's
Yeah,
step 6. So I
yeah.
noticed that from that formula we have the risk premium minus risk-free rate, but we did not subtract 4.5 from this 3.5. So why did you use only 3.5?
No, I've already explained it now. That's what I put this dash here. You can see this dash I put here. The difference between market return, RM, this RM represent market return, okay?
Okay. Yes.
The RF is the risk-free rate of return. So the difference between market return and the risk-free rate of return is what is called risk premium. That's
Oh,
called
okay.
risk premium. So examiner has given to you risk premium. So there's no need for you are not given market return. So the difference between RM and RF is what is given to you as 3.5. Okay?
Okay. Thank you, sir. All right.
You're welcome. Yes, so this is where we are going to call it a day. If there's no further question, I will see you next time by the grace of God when we shall be starting a brand new topic. Good night to you all.
Nice. Thank you.
You're welcome.